Good morning.
Good morning.
Cool. I needed to know somebody could hear me. Thank you, Connor. I've got that. No, not now, later. Want to hear a terrible joke? Okay. Got this from our pastor. It is very corny. There was this small church that had a tower with a bell up at the top. And they had somebody that would ring the bell, but they retired. So they had tryouts for someone new to ring the bell. Different people would climb up to the top of the tower and ring the bell. They had all kinds of different hammers and so on. And there was one guy that climbed up there,
Hey, Millie.
draw back with his head and literally kept up the bell. But it made such a beautiful sound, they hired him. So a few weeks passed, and one time he went up, drew back his head, and he missed. Fell out of the tower down to his death. The parishioners are gathered around, and they suddenly noticed they never got his name. And the pastor said, "Yeah, I don't have a name, but his face rings a bell." Ooh.
That's good.
It's terrible. Oh, when I was in college, I had a class where the prof was a big Aggie. Well, he wasn't an Aggie fan, but you'll get bonus points to the person who came up with the best Aggie joke. We're not going to do that, but I'm waiting a couple of minutes till noon to start. My timepieces say it's a minute or two till noon. I'm just curious, with this particular class, attendance is awfully good. I'm not used to that for online classes, but do any of you afterwards, later in the week, go back and look at the Zoom recording of the class? And I'm not seeing any yellow hand. Paul does, okay. I didn't know. I mean, if you feel like you get enough of it through the attendance, great. If you want to go back and look at it, I mean, it's there for you to look at as many times as you want. But and I have posted voiced over PowerPoints. I'm still working on chapter 12, but I'll have that up before we get to it. I'll have that up this week. My voice changed for the worse over the last couple of years. Back when I made those voiced over PowerPoints, my voice was in better form. Not great, but everything's relative, as Einstein says. So it was better. All right. Let's begin, but let's begin by skipping some slides. In this PowerPoint file, I included some slides I should not have. So you may skip. Why does it do that? You may skip slides number 28 through number 32. I covered a topic that really shouldn't be in a principles class, so you can just skip those slides. Since we finished with slide 27 last class meeting, now we will go to, that's interesting. One second. That's better. Now we'll pick up with slide 33. Your author calls this putting it all together. I actually did this with another example earlier, but let's assume that Ultra's optimal capital structure, based on market values, by the way, the capital structure should be based on market values, not book values. That may not make any sense to you since we didn't calculate that anyway. But it's felt that the market value capital structure is closer to shareholder wealth, which is what we're trying to affect. So for Ultra, it's 37% debt, 63% equity. And let's also assume that Ultra has decided the dividend model best reflects its shareholders' expected rate of return. So what would be the WACC for Ultra? For Ultra, it's only two sources of funding: our debt and retained earnings. That's its source of funding for common equity. And since the weights are 37% for debt and 63% for equity, we then go back. If you recall, we found the cost of debt to be 6.1%. And using the dividend model, the cost of equity, retained earnings, was 15%. So that gives Ultra a weighted average cost of capital of 11.7%. What is this? This is the hurdle rate that projects have to beat to be acceptable. Or you could think of this as the minimum required rate of return on new projects. So, what if Ultra has the following three projects, A, B, and C? Right now, let's assume they're all average risk, and we've got a WACC, a hurdle rate of 11.7%. Project A would cost 300 mil. Its expected rate of return is 10%. Is Project A good enough? Would we accept A or reject it? Remember, the WACC is the minimum that we require. Is Project A good enough? No. We require at least 11.7. A's expected return is less than that, 10%. What about Project B? Is B good enough with an expected return of 18%? Yeah, it's well above our minimum required. So we would accept Project B. What about C? Is it as good as B? No. But is it acceptable? Yeah. We expect 13%, we require 11.7. So C beats the hurdle rate, so it's acceptable. So what would be the size of our capital budget outlay? How much would we spend on new projects? 500 mil. And actually, the next slide simply goes through what I just did. We'd accept B and C. So we'd spend a total of 500 mil on projects. Now, sometimes it's good to put this on a graph. Do not freak out at the next graph, the next slide. We begin where x-axis is the capital budget, how much we spend. Our y-axis is a measure of return. And I'm drawing that WACC like it's 11.7. I guess I should have drawn that as a straight line. There's a reason I didn't, but for now, if you want, just pretend it's a straight line, 11.7%, period. The next thing we do is we superimpose, that is, we put are 3 projects on here, but we start with the best of the 3. Which of the 3 projects is the best of the 3, A, B, or C? I'm going to hold out till somebody responds. Say again, James.
B.
B. So what we do is we put B on there. Its expected rate of return is 18%, and it would cost 400 mil. So we start with our best project. What's the next best project of the 3? Isn't it C? With an expected return of 13%. It would cost 100 mil, driving our total outlay up to 500 mil. And then if we put the last project on there, that would be A, with its expected return of 10%. Now, what do you call this? We call this the investment opportunity schedule. Let me write that in red since that's in red. Investment opportunities schedule. Man, oh man. iOS. What is it? It's a graph that lists our projects from best to worst. Now, what I want you to notice is this little spot where it intersects. That was supposed to be green. Notice that to the left of the intersection of the WAC curve and the iOS, to the left of this intersection, we've got projects that we accept. Why? Because their expected rate of returns are greater than our cost of capital. They beat the hurdle rate, so they're acceptable. To the right of that point, we've got projects that we reject because their expected rate of return is less than the cost of capital. They don't beat the hurdle rate. And that's a great test question. What's the significance of the intersection point? We accept projects to the left of the intersection point and reject projects to the right. And because we're only accepting projects B and C, then our capital budget will be 500 mil. We'll invest a total of 500 mil in new projects. Any questions on this? Okay. Try this problem. See if you get my check figures. In fact, this problem and the projects on the next slide. Try these 2 slides and see if you get my figures. All I'm doing is just writing the information given on the slides. Did you guys get my 14.2 whack? What is average cost of capital? Did anybody?
Yes.
Cool. All right. So what's our decision for project M? Will we accept it or reject it? We require at least 14.2. With them, we only expect 13. So we turn it down. With project N, we expect 17%. We require 14.2, so it beats the hurdle rate. So we would accept project N. And that would mean our capital budget capital outlay budget, well, it'd be what the cost of project N would be. That'd be the only thing we'd invest in. Questions? You know, of all the chapters we cover, this one has the easiest math, and yet conceptually, it's the most difficult to wrap your head around. So,
Yeah.
just a brief review of some of the stuff we've been doing. This is great for multiple choice questions. Are our component costs on a before tax or after tax basis? If we say after tax, that means we consider taxes. If we say before tax, that means we ignore them. Did we consider taxes. Yeah.
I flicked my underwear like this and then caught it behind my back.
If you recall,
Yeah.
whoa, if you recall, to come up with our cost of debt, we multiplied by 1 minus the tax rate. So we considered taxes. And for the cost of equity, anything paid to the shareholders has to be out of after-tax income. So our RCBS is in after-tax form. You know, if a company wants to pay a dividend, the government says, yeah, you can pay a dividend, but it has to be out of after-tax net income. They can't pay it out of before-tax income. So do we consider taxes? Yes. Our component costs, that is the required rate of return on debt and equity, are in after-tax form. Did we consider flotation costs? Yeah. Back when we were looking at Ultra's bonds, if you recall, they'd be sold to the public for $1,000 face value. But investment banker fees were $20 a bond. So the amount that Ultra nets was $980. And when we calculated the before tax cost of debt, R sub D, we use what the company would net after flotation costs. So do we consider flotation costs? Absolutely, yes. Now this I didn't go over. Just note that when we calculate the cost of capital, the weights, the weight for debt, the weight for equity, they're market value weights. Why? Because market value is closer to shareholder value than book value. We're not trying to maximize the book value of the stock. We're trying to maximize the market value of the stock. So our weights, when we calculate WACC, they are market value weights. The slides I skipped showed you how you calculate those, but don't worry about it. Just take it from that. Just memorize, if you have to, that the weights are based on market value. When we calculated those component costs, were they historical costs or incremental, that is new cost? And the answer is new costs. If you're thinking of starting a business, let's say that's your project, the interest rate you paid on debt in the past is irrelevant. What's relevant is the interest rate you would have to pay on new loans to finance your business. So our focus is on incremental, that is new costs, not historical costs. Are short-term sources such as current liabilities included as a source of capital? And the answer is no. By definition, capital refers to long-term sources. Sorry about that, of funding. If you look at a balance sheet and you look at the right-hand side, those are your sources of funding. First, you see current liabilities, then you see long-term debt, then you see equity. Current liabilities are not capital. Everything below them is. Now, with our last class meeting, I mentioned that companies do not like to sell new common stock. They prefer to use long-term debt and retained earnings, which means profits they've already got their hands on. And I went through the reasons why. Companies don't like to sell new common stock because they incur high flotation costs. The riskier the security you ask an investment banker to sell, the higher will be the investment banker fees, which are part of flotation costs. And stock is riskier than bonds. So if you ask an investment banker to sell bonds, they'll quote one fee. If you ask them to sell stock, they'll quote a higher fee. So one reason to not sell common stock is to avoid the high flotation costs that investment bankers would charge. Also, if you're concerned with controlling the company, maintaining control of the company, votes will go with the new shares. And an outside interest group might buy up enough shares to have enough votes to gain control of the company. So that's another reason companies don't like to sell new shares of stock, concerns over loss of control. And finally, that whole issue of asymmetric information. Management knows things about the company's outlook that outsiders don't know. In fact, we call that inside information. Outsiders are always looking for clues to what management is thinking. And if management decides to sell new shares of stock, investors believe they would only do that if they thought the stock, if management feels the stock is overvalued. And of course, that's a negative signal. And if the market gets the message that management thinks the stock is overvalued, stock price will fall. And that's not what we want. We want to do things to make the stock price go up. And yet, sometimes companies have their backs against the wall. They're forced to sell new shares of common stock. They've got some great project proposals that have a high rate of return, yet they've borrowed to the max. They can't borrow anymore. And they don't have the cash to fund the new projects. So the only alternative would be to sell more shares of stock. So earlier, we found R sub S, which we referred to as the cost of retained earnings, or if you want to look at it this way, the required rate of return. Yeah. Companies made a profit is thinking about using some of that profit to fund new projects. What rate of return should they require? The rate of return that stockholders are expecting on their stock. Again, that refers to the cost of retained earnings funds, profits, equity funds, if you will, that the company already has its hands on. However, what do we do if we don't have sufficient retained earnings and we've got to sell new shares of common stock? How do we determine the required rate of return? We actually use the dividend model. Look at this particular problem. Ultra needs to sell new shares of common stock to fund a really good project. The stock price right now is $21. That's what we call P sub 0. The price of the stock in the market right now. If they want to sell more shares of stock, however, you're going to have to cut the price. What did they teach you back in economics that you have to do to the price if you want to sell more of anything? You've got to cut it. So new shares are going to be offered to the public at at $19 per share. That's a $2 discount. And investment bankers who don't do this for free will also pocket $3. If you recall, for Ultra, this is just the same information to a degree. We earlier calculated the dividend for the coming year as being $2.10. The stock price is 21. The growth rate in dividends is 5%. So were we calculating the cost of retained earnings, R sub S, which we did earlier, we would take the dividend in the coming year divided by the stock price plus the growth rate. And we got, with the dividend model, a cost of retained earnings of 15%. But what if we now want to find the cost of new common stock? That is the rate of return we must earn on money raised by selling new shares of common stock. Well, first note that Ultra would only net $16 per share. Or another way to look at it, the net price would be the current price of the stock minus the discount minus investment banker fees, or ran out of room. Sorry. $21 minus that $2 discount minus the investment banker fees, they'd net $16 a share. So what we do is we use the dividend model, only instead of the current price of the stock in the market, we divide by the price the company would net. They'd net $16 a share. And that gives us a cost of new equity that is a minimum required rate of return on funds raised by selling new common stock of 18.1%. Note that with the cost of capital, that would push it up. If they have to use new common stock instead of retained earnings, it pushes the cost of capital up to a higher level. By the way, do we want the cost of capital to be higher or lower? We want it to be lower. Well, look, the cost of capital is the minimum required rate of return on funding for a project to be acceptable, for a project to add to shareholder wealth. It's easier to find projects that will add to shareholder wealth if our cost of capital is lower. Or another way to look at it, part of it involves the interest rate on debt. Would you rather pay a higher interest rate on debt or a lower interest rate? You'd rather pay a lower interest rate. You'd rather that interest rate would be lower because it would make your cost of capital lower. The hardest concept for students to wrap their heads around in this whole chapter is the idea that we want the cost of capital to be as low as possible. I mean, corporations would love it if it were just zero. Then it would be really easy to find projects that add to shareholder wealth. For the same company, the cost of new equity is higher than the cost of retained earnings because to get the new equity funds into the company, they incur additional expenses. So they've got to earn a higher rate of return to cover those additional expenses. With retained earnings, the money is already in the company. They've already got their hands on the cash. So the cost of new common stock is higher then the cost of retained earnings to cover the additional flotation costs. Just for grins, try this problem. See if you get my figure. Yeah, there. All I'm doing is writing down the information. Did anybody get my check figure?
Yes.
Cool. You know why I ask you? Because I make mistakes. If I know you guys got my figures, that means I didn't make the mistake. Just for grins, this isn't part of the problem, but what if we've got a new project. I don't know, Triple Z. Vin Diesel, say hello. Okay. Its expected rate of return is 25%. Oh, wait, I'm sorry. Never mind. Went too far. Okay. Any questions on this? Okay.
Hey, shouldn't the P net, shouldn't it be 18 minus 3?
Did I mess up?
You got the same figure as me, but the way you went about it seemed different.
Yeah. Isn't that basically what I did?
I guess that's what I was asking. Is it?
Paul, you do the math.
Well, yeah. Mathematically, it's correct. Yeah.
Yeah. I was just breaking it down a different way.
Okay.
The stock's trading for 20. If they're going to sell the new shares at 18, they're knocking $2 off. That's the discount. Okay. Now, we looked at debt, we looked at retained earnings, we looked at new common stock. Although there aren't many companies that sell this, there are a handful of companies that sell preferred stock. These are basically your power and gas companies, your regulated monopolies, like energy. With common stock, we expect dividends to grow over time, get bigger. But it happens that with preferred stock, and this is just how it's designed, they pay the same dollar dividend quarter after quarter forever. So do dividends grow with preferred stock? No. If your salary never got bigger, what would be the growth rate in your salary? 0. So, what do we do to find the required rate of return on money obtained from selling preferred stock? We use the same model we would use for common stock, or for that matter, new equity. But we set the growth rate equal to 0. And what that leaves us with is this model for determining the required rate of return on preferred stock. Notice with common stock, that time subscript matters because D2 would be bigger than D1. D3 would be bigger than D2. We'd need to know which dividend it was. But with preferred stock, they're all the same. So we drop the time subscript. So let's assume Ultra, although it's unusual, it's going to sell preferred stock to raise money. The preferred stock will pay an $8 annual dividend. It'll be sold for $100 per share. And by the way, while the par value of bonds is always 1,000, for preferred stock, the par value can be anything. I've seen preferred with a par value of 100. I've seen preferred with a par value of 10. I've seen it for a par value of 50. There is no standard par value for preferred stock. So new shares of preferred stock can be sold for $100, less a flotation fee of $5, and they'll pay an annual dividend of $8. So what is the component cost of preferred? That is, what is our minimum required rate of return on this source of funding? By the way, that 9 should not be there. It would be our dollar dividend of $8 divided by what the company nets, which would be $95 a share. If it's sold for 100 and investment bankers take 5 of it, they net 95 a share. So the required rate of return would be 8.4%. You know, back when we found the cost of debt, we found the interest rate on debt and multiplied it by 1 minus the tax rate, because interest expense paid on debt is tax deductible. Should we multiply our answer down here by 1 minus the tax rate? No. Dividends paid to shareholders, our government looks at interest expense on debt as a cost of doing business, so it's tax deductible and has a tax savings. But our government looks at dividends paid on stock, whether it's common stock or preferred, not as a cost of doing business, but just as a distribution of profit. So it's not tax deductible. We should not multiply this by 1 minus the tax rate. This is already in after-tax form because dividends have to be paid out of after-tax income. Try this problem and see if you can get my check figure. What? $5 divided by 92. There. Are you guys getting my figure? Pretty straightforward, isn't it? Did anybody get a different figure? I'll ask it that way. All right. Going back to Ultra, if Ultra did use preferred stock funding, and this were its capital structure, it'd be using 3 sources of funding. So its revised weighted average cost of capital would be different. Here I went back to assuming that for common equity, they're using retained earnings. How is preferred stock unique? It is really unique. It's only sold by regulated monopolies. Energy, Western Gas, Con Edison Electric, companies that provide utilities. like electricity or gas. And at one time, telephone companies came into this, but now that market's not regulated. So the issuers, the companies that sell preferred stock to raise money, are regulated monopolies. GE, Con Edison, GE, Microsoft, companies that are not utilities don't use preferred stock funding. And the other unique thing about this, you and I should never invest in preferred. The investors are other corporations. Why? Corporations get a huge tax break. At least 70% of dividend income received by corporations is tax exempt. If Microsoft invested in the preferred stock of Entergy and Entergy paid dividends to Microsoft, the bulk of those dividends wouldn't even be taxable. Because of that, corporate investors accept much lower yields on preferred stock. They drive yields down to a level that you and I couldn't justify because they're too low. So preferred stock, it's only sold by regulated monopolies, utility companies. And the only investors in preferred are other corporations, not individuals. Here's something you'll like. It's an interesting point, but the truth is, it's not on your test, so you may skip it. The next two slides. Any objection? All those in favor, show me the yay sign. In favor of skipping the slide? Yeah, I thought so. Okay, thank you, Jason. Now, the final major topic, and we're good for time, is risk. So far, I haven't mentioned risk. So far, when we calculated the WACC, we assumed that would be used for average risk projects. I mean, back when we looked at projects for Ultra, projects A, B, and C, when we looked in our example, projects M and N for Jones Company, we assumed those were all average risk. But the truth is, corporations are risk averse, just like you and I are. Faced with higher risk, they apply a higher required rate of return. So they do this with capital budgeting projects. Riskier projects, they apply a higher WACC to. And for most companies, they kind of do this subjectively. Let's assume Ultra's basic WACC is 11.7%. That would be appropriate for average risk projects. But let's assume that Ultra adjusts the WACC either up or down 3% for projects that are not average risk. For example, Ultra may take all of its project proposals and put each one in one of three categories. For average risk projects, the hurdle rate would be the WACC. But for high risk projects, they add another 3% and require a higher rate of return. And likewise for low-risk projects, they deduct 3% and require a lower rate of return. Where did the 3 come from? Arbitrary. It's not out of a formula. Every company just subjectively comes up with an adjustment. And by the way, in this example, we're looking at 3 risk categories. Some companies may have 5 risk categories, like high risk, above average risk, below average risk, low risk. I don't know, 5 categories. Let's assume Ultra is looking at 3 projects. Project X is high risk, so the risk-adjusted weighted average cost of capital for X is 14.7. For X, that's the hurdle rate. If the expected return is 14, is it good enough? Not quite. So we would reject X. Even though it's got a fairly high rate of return, it's also got a high level of risk. Project Y is average risk. So we make no adjustment to the cost of capital. We require 11.7. If project Y has an expected rate of return of 13%, is it good enough? Does it beat the hurdle rate? Yes, it does. So we would accept project Y. Project Z is a low-risk project. So Ultra drops its risk-adjusted capital down to 8.7% because this is a safer project, a low-risk project. If the expected return is 10%, would Ultra accept project Z? Is it good enough? Yes. When we evaluate projects, we should use the risk-adjusted cost of capital. We need to take risk into account. And oddly, this little example where management just arbitrarily adds or subtracts 3%, that's actually pretty common practice. Where does management come up with that plus or minus 3 or plus or minus 2 or whatever it uses? Subjectively. I read an article about one CEO who said what he would do when he would look at a project to figure out which category to put it into, he'd lean back, close his eyes, and if he envisioned an onrushing locomotive, he'd call that a low-risk project. If he leaned back and closed his eyes and he envisioned a sinking ship, he would call that a high-risk project. It is somewhat hilarious how they come up with the adjustment for risk, but they do and they should. Try this problem. And for projects M and N, tell me whether you would accept or reject the project. And just for grins, instead of calling this Dolby, let's call this June Corporation. Because earlier I called a company Dolby and I used different figures. Oh, what did I leave out? Ah, right. And let's add project Q just for grins. Whoops, 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 whoops. Did you get a risk adjusted cost of capital for M of 5%? If the expected return is 6, what's our decision? Accept or reject? If the risk adjusted hurdle rate is 5% and we expect more than that, we'd accept. What about for project N? Our risk-adjusted hurdle rate is 9%. We expect 8. So we'd reject project N. And project Q, since it's average risk, we just apply the basic cost of capital. Since we expect a little more than that, we would accept project Q. So what would be our capital budget? How much would we spend in all on acceptable projects? Let's see, we'd accept M, we'd accept Q. So we'd spend 350 mil. Does that make sense to you? Somebody show me a hand or thumbs up or something if it makes sense. Cool, thank you. Now, note that some factors that affect the WACC are within management's control. Management can decide to a degree how much it's going to use in debt, what kind of projects it's going to invest in, and how much of its profits it's going to distribute to the shareholders. We think of these as endogenous factors, factors management can control or exert influence over. But there are also, and if today's not an example, I don't know what is, there are also factors that management cannot control. The state of the economy, the general level of interest rates, the level of inflation, and other things. These are considered exogenous factors. The key point here is that there are some factors that affect WACC that management can influence, and some factors over which it cannot have any influence. One final point, and we're out of here. A lot of managers get evaluated with EVA. If you recall, what EVA is actual operating after tax profit minus what the market expected. And if you recall, we like actual profit to beat expectations, because when actual profit beats expectations, we have a positive EVA, economic value added. We have a positive EVA. More importantly, when actual profit beats expectations, the stock price goes up. When actual profit falls short of expectations and we have a negative EVA, the stock price tends to drop. We'll note that part of our expected profit involves WACC. So just out of a selfish motive, management has a motive to make WAC lower because that'll make EVA higher. And management, a lot of managers are evaluated based on EVA. So management really has a motive to minimize WAC just for the best interest of the shareholders. The lower the WAC, the lower the hurdle rate on projects, the lower the rate that a project has to beat to add to shareholder wealth, the easier it is to find projects that beat the WAC. We want a lower WAC. But boards of directors have also built management performance evaluation based on EVA. So managers have a selfish motive also to try to minimize WAC. And that's good because that aligns the motive of management with the best interest of the shareholders. And as Forrest Gump says, that's all I have to say about that. Any questions? All right. Today's Wednesday. Do we meet Monday? No. Monday is considered a holiday. Classes that would have met on campus during the day that are now online are canceled. I consulted with the registrar and the dean. They said Monday classes, day classes are canceled. So when will I see you guys again? In a week, next Wednesday. And if you will, bring your slides for chapter 11. I still am working on finishing the slides for chapter 12, but I'll have them up later this week, well before we get into chapter 12. Anything else, guys? Have a safe week. Be safe. I'll see you Wednesday. Bye-bye.